Sensational headlines, half-baked insights can be detrimental to your portfolio. Take, for example, the recent developments that have happened with the Fed chairman, Jerome Powell, announcing that Fed would be tapering the buying of the assets that typically fall under the treasury bonds. Now, this information, as soon as it came, basically meant to a half-informed, half-baked, half-insightful investor, meant that he should be selling his holdings. Kyun? Because he was under an impression that when it happened, the taper tantrum in 2013, the markets had corrected. Now, this is where you need to be very, very cautious. And this is where we will try to inform, to educate, to appraise you of what is really something that you should be doing if such an event happens. There is a popular feeling that the markets may correct big time. And there is a popular feeling that now you should be selling your stocks so that when the correction is there, you're not affected by it. Mat kijiye, don't do this, because we will be presenting two sides of the coin to you today. One side is that of a person who is going behind the news and the headlines, and the other side, that of an informed investor that you should be. And that is the reason why we conduct the Informed Investor series for you every given week, so that anything that has happened in the past 7 days, you would be able to decipher, you would be able to make a note of. Today's Informed Investor is a masterclass. Why masterclass? Because once in a while, once in 2 months, once in a month, whenever we feel that something significant has happened, we will come back to you and tell you that there is a lot more to learn behind the headlines, and hence masterclass sessions are unique, are rare, are collector's edition. Sit back, relax, because I'm not asking 15 to 20 minutes from you today. I'll ask for a little longer time. Remember, today's session is a masterclass, a collector's edition. Congratulations, you're watching The Informed Investor, the Third Umpire, by research and ranking. Shall we begin? Let's understand the importance of what interest rates are. What do they do to the markets? And if you're able to appreciate and acknowledge the importance of interest rates to the stock markets, then you'll be able to understand the relationship it has with bonds. And once you're able to understand the relationship it has with bonds, then you will be able to understand the recent announcement which has been done by the US Fed chairman of exactly what it will do to the markets. And once you understand that, you will be able to decipher and appreciate that your portfolios will get affected by some way. But what way? We'll understand this as we go along today. All right. And in the end, I will present to you the two scenarios, the pros and the cons of it, the two sides of the same coin. But it is very important for you to understand both the sides today. All right. So let's begin first by understanding the impact of interest rates on the stock markets. Now, interest rates, let's suppose the scenario is that the central bank, in this case the Fed, increases the interest rates. Now, when the interest rates are increased by the Fed, then it basically escalates the short-term borrowing costs for financial institutions. Financial institutions don't keep these costs to themselves. They pass on the costs to the end consumers as such, to the companies who are borrowing it from them. Now, when the interest rates rise, the cost of borrowing basically rises for a given company, and hence, with the cost going up for the company which is taking loans from the financial institutions, a similar scene can be seen with consumers like you and me. Our credit card interest rates go up, our mortgages go up, our EMIs go up, and in this given sense, we now start to taper. We also taper. We start to taper our discretionary purchases. You know, the discretionary purchases are things which are a little ambitious, but beyond the core buying that needs to be done daily. These are things which are good to have, and you have been saving for them. But now with less money in your hands, because the EMIs have become a little dearer to you, this is where the cost of borrowing goes up. Now, in this given sense, there are two things which will start to happen. One, the discretionary spending will go down. Right? And for companies, there are two whammies that basically get played out. Number one, for the companies, the impact on higher borrowing cost is clearly seen. Number two, the companies are also now getting affected by lower sales because consumers are not buying that much as they did earlier. So with these two developments, what also happens is that the earnings estimates of the companies, this is what the street interprets, will start to come down. Why? Because the revenues have come down, because consumers are not buying as frantically they did earlier. And number two, there is a higher debt on the books of these companies because of the borrowing. And if the earning estimates start to come down, the stock markets start to also come down, in a sense that if one company does come out with estimates which are lower than the previous quarter, and there are many companies that do that, then during that short period of time, the index basically experiences the effect and there is lesser buying, or the PE shrinks for that given time along with the margins as well. Now, this is what happens to the stock market when the interest rates go up. Needless to say, the naive investors who are participating for the first time or have little experience start to get very, very panicked. Now, that is where they see corrections that are happening to their portfolios and they start to exit, they start to sell their stocks. And that is the moment that they feel that the stock markets are in risky asset class. Okay. But all does not go down. There are certain sectors that benefit when the interest rates go up. For example, banking, for example, brokerages, for example, mortgage lending companies, for example, insurance companies. These are the companies where the lending rates really go up and the profitability also shoots through the roof. So now if you want to sum up what happens with the interest rates, right? When the market or when the economy is slowing down, right? When the demand, when the consumption is low, the government, the central bank pumps in liquidity, pumps in the stimulus, lowers the interest rate. Because of the lower cost of borrowing, the people start spending more because they have more discretionary spending budget in their hands. Likely so, what it does is that it raises the street estimates of the earnings that are ahead. There is an overall euphoria, the stock prices start to go up, and hence prolonged, or rather a very subdued interest rates regime leads to consumption, leads to economic recovery. That is what is happening, because when COVID began, most of the central governments started to pump in the liquidity stimulus packages. The interest rates have been kept down and the economic recovery and demand has gone up. Now let's understand the importance of bond prices and interest rates. But first of all, you need to understand what bonds are, right? Now, like you and me, like the institutes, like the companies, government too needs money at times. It too needs an effort to raise funds at its end. And it does so by issuing bonds. So bonds are nothing but loans that are getting funded because of the investments that you and I do or institutes do. But whenever we are giving loans to somebody, we need the interest payments back as well, right? So this is what is constituted as a coupon interest that comes back to the bond bearer. And after a fixed time, whenever the maturity happens, in 1 year, 3 years, 5 years, 7 years, 10 years, 15 years, 20 years, 30 years, there is the principal amount that gets returned along with regular interest that the bond bearer gets. Okay. Now we've understood what bonds are. Also keep in mind that bonds, specifically the US Treasury, are considered to be very, very safe investments because it is assumed that US Treasury will at least not default on their interest and their principal repayments to the bond bearers. So they're relatively very, very safe class of investments to invest with a fixed coupon and interest coming at a regular frequency. Now, what is the interest between bonds and interest rates? See this. Here is interest rate and here is a bond price. Whenever interest rates go up, bond prices come down. So they are inversely proportional. Again, whenever interest rates go down, bond prices go up. Keep this in mind. So they are inversely proportional to each other. So when we discuss in the next few minutes that the interest rates are expected to go up, please keep in mind the bond prices are expected to go down. Keep that in mind. Now, also keep in mind that there is a correlation between interest rates and inflation rate. Okay. Now, assume this, and this is going to be um, a very crude way of explaining this to you. I hope you understand it. When interest rates are down, when interest rates are down, there is more discretionary spending that is seen. We have a lot of money in our hands to spend. Now, when a particular seller is able to sell a product at a particular cost and there is a discretionary spending which is elevated, then people are willing to pay a higher price for that particular product. Now, if the product is very smartly priced by the company is a little more expensive, the discretionary spending by the people allows it to be able to buy it at a higher price. So what happens is when there is liquidity, when the interest rates are low, when there is more discretionary spending available with everyone, then the prices keep going up. That is why it is said that whenever interest rates are down, inflation tends to go up. And this is the trick that central banks have to balance out, because when interest rates are continuously kept low for a very long time, then the effect on inflation is always to be monitored, and there is a set benchmark. For example, RBI का 6% है. For example, US Fed का 2% है. So they have benchmarks, they have targets that they will ultimately keep in mind before they start to increase interest rates. So I hope now you've understood the relation between bond prices and interest rates and the relationship between interest rates and inflation. Now let's rewind the memories of the taper tantrum, the word that you and I are get jitters whenever we hear this of 2013, right? What happened? Why is taper tantrum such a feared word? Why does it give jitters to all across the investing community? To understand this, first of all, do you know the definition meaning of tantrum? Tantrum is basically uncontrolled outburst of anger and frustration. So anger or frustration किस में है? This is with the investors, right? So let's rewind the memory back to the financial crisis that had happened of the subprime mortgage lending crisis. उसको बोला जाता है financial meltdown बोला जाता है of 2008. There was a lack of trust. There was a deficit with the people in the banking sector overall, and hence the Fed needed to jump in and infuse the confidence and infuse the stimulus. Now, what did Fed do? Fed continued a buying spree of assets such as the treasury bonds. In fact, at one given point in time, Fed had it on its balance sheet $1 trillion worth of treasury bonds, which actually had swollen to $3 trillion worth assets that it had bought. Now, whenever Fed had bought such an amount of assets to infuse the stimulus, to infuse the liquidity in the market, and to keep the interest rates down, people thought that Fed had a moral obligation to do this forever. So that is where I come to the main dichotomy, that when somebody comes to help, you take them for granted. In a similar sense, the investing community took Fed for granted in saying that Fed has a moral obligation to keep supporting the market forever. And what happened in May of 2013 is that the Fed chair, Ben Bernanke, came and said that the Fed might reduce the buying of treasury bonds. Now, this information alone was enough for the market to go into a turmoil, right? So when Ben had announced that Fed would at some future date reduce the bond purchases, people basically took it for granted that this was the support that the markets needed. Now that support is being withdrawn. Now, bond prices of the particular institution which is buying in bulk, if that institution stops or starts to taper the buying, अगर वो अपनी buying को कम कर रहे हैं, then the bond prices will basically start to come down. And you know what happens when the bond prices come down? We just visited. The likelihood of interest rates will go up, and when interest rates go up, you remember what we discussed, that the likelihood of people fearing that the stock prices may correct. So what happened during that time is then when this announcement came, there was about 6% correction that was seen in the US indices at that particular point in time. Though the Fed chair came back and said that this was being done, this was being professed due to the strong faith in the market recovery, and there was a boosting of sentiments overall. There were very frequent communication bits that were then translated by the Fed to the market, which calmed the nerves. By the way, between 2013 and 2015, the Fed further bought 1.5 trillion worth of bonds. Now, this is what is being referred to as taper tantrum. Taper, start to reduce, and tantrums of what the investing community did. Now, do you understand what Taper Tantrum 2013 means? Now, let's understand the effects of the recent announcement that the Fed Chair Jerome Powell did. And this is what people are now starting to coin as Taper 2021. Of the recent FOMC meet, the July meet that had happened, the minutes were published, and Jerome Powell, the US Fed chairman, came and said that the central bank could, please focus on the operative word, the central bank could begin to taper the 120 billion per month bond buying program by the end of the year. He did not mention a specific date, a specific month. He said by the year. What's more important, the Fed said, was that the Fed won't be in a hurry to begin raising the interest rates thereafter. So two significant things. Number one, what the Fed said was that they could begin tapering. And the second thing they said is that the Fed won't be in a hurry to begin raising the interest rates. And these are the two things that acted as that adrenaline rush, that booster dose to the bulls. So the bulls were very happy on two accounts. Number one, they were expecting these measures to be taken as early as September. The Fed said end of the year. The bulls were the people were expecting that some amount of interest rate hikes will be there. The Fed said that the interest rate hikes are not going to be there for a foreseeable future. And these are the two things that caused the markets to go up. The US markets cheered, and it's not a surprise that India is cheering that as well. Now, one of the things you have to keep in mind is that the Fed has said that it is not said if, it is said when this will happen. Keep that in mind. There are 3 more meetings that are coming up. For the first meeting is on the 21st and 22nd of September. The second meeting is on the 2nd, 3rd of November. The third meeting is on the 14th and 15th of December. Now, it may well be that the Fed may decide to raise the rates then. The Fed may decide to announce the final tapering of the 120 billion US assets buying program. Whenever that happens, there will be certain corrections that will be seen in the market, but there are certain prerequisites, qualifiers, because of which the Fed said that they're going to be doing this. There are 2 qualifiers or 3 qualifiers. The first is Fed said that it has met its substantial further progress of reaching the inflation goal of 2%. So they said the moment it crosses 2%, it will be an indication for them that the economy is revived. And that is where it will start to think of tapering the asset buying program. Number 2, actually the labor market has made a clear progress. The unemployment rates, which had gone to about 16%, are now 6%. Okay. So now with these developments in mind, the Fed is saying that there could be a tapering which is done. Now, the big sensational news. देखिए इस चीज को ध्यान से समझिए. Now listen to this. This is how people are interpreting, okay? This is how people are interpreting this. That the Fed announces the tapering of the US bonds purchase, because of which the interest rates go up. Now, as interest rates go up, the stock markets start to correct. When stock markets are correcting, bond prices, because of increased rates, are coming down because Fed is not buying it as rigorously that it was doing it before. When bond prices are coming down, bond yields are going up. Bond prices, bond yields, bond के prices कम होते हैं तो yields बढ़ जाती है. Now when bond prices are coming down, bond yields are going up. Bond yields are going up, that means the returns on the bonds are going up. And these are risk-free. Now if stock markets are expected to correct elsewhere, and FIIs are also investors, then they will always consider a risk-free asset that they will purchase. So they will start to move their money from emerging markets and start to invest it in places where there is risk-free but an increased rate of return. This is what is freaking out the emerging markets. And this is where people are cashing in the sentiments, the chaos, the overall sensitivities, and trying to spread rumors. Will the Fed do this? Will we see the interest rates go up? Will we see the stock markets getting affected? Will we see FIIs pulling their money out of India? Let's visit. Now you've come to know the headlines, you've come to know the topics, you've come to know the interrelations between bond prices, interest rates, inflation, US Treasury, buying, not buying, tapering, not tapering, markets going down, not buying, not going down, FIs pulling their money away, or the possibility of it. You know that now. Hopefully you've understood everything now. Let's go with data. Because there is a saying that that in God I trust, others may bring data. Let's talk about data. Because data suggests that FIs are actually not, there is not a mass exodus of FIs from the Indian markets. Of all the things that we've discussed, it's true that in July, FIIs sold about 23,000 crores. It's true that in the month of August, that figure came down to 2.5 thousand crores. In the month of September, though it is only 1 or 2 days, 666 crores of equities have been bought by FIIs. But for the year till date, 7 billion US dollars worth investments have been made in the Indian equities market by the FIIs. You tell me, is there an exodus of FIIs? Data doesn't suggest that. Number two, it is believed that these are very initial days of the quantitative easing. It's a very initial days. Number three is that UBS and the analysts from there are saying that there will be very modest headwinds when the tapering begins. But stocks which are of low grade quality will suffer the most. This is not the taper tantrum of 2013. Because it is not 2013, okay, that's a very lame way to put it, but this is not 2013. This is a lot much more than where we are in 2021. Take an example. The macroeconomic conditions are not the same. The macroeconomic conditions have improved if we compare it to 2013. Number two, economies are much more stronger now across the globe. Many of the companies have started to report earnings which are very healthy, unlike in 2013. Third, the tapering of the bonds, whenever it happens, the purchase will not result in an economic slowdown. It is a wide belief that this will not happen. Next, unlike 2013, this time the Fed is telegraphing its intents in baby steps with caution and doing it the right way. So this is not bringing the shock elements to the market. In fact, it is helping the markets calm the nerves that these are the steps that need to be taken. The fear gauge, or as we know it is the CBOE volatility index, basically went down by 13% last Friday. As of now, it stands at about 13.3, which is much lower than the previous peaks. So what does it say? It says that the markets are at ease. Last but not the least, some of the analysts are believing that it is still not the right time, specifically when the Delta variant is on the loose. Specifically, that the Fed may still decide not to go with the tapering announcement as early as the month of September or as early as the month of November. It may still be the fourth quarter of 2021. Now this brings us to the final part of today's masterclass session. I'm a little hurt, a little astonished, a little surprised, a little shocked when I see headlines, when I see videos on YouTube. I'm reading a title of a video which is published. It says, "Market crash looks like 2013 taper tantrum." This is a video out there. It's basically saying that there's going to be panic whenever the tapering happens. You know, as informed investor, what we're trying to tell you is that we are trying to make you a very, very informed, a very educated, a very insightful investor. Even if something happens like this, what should you do? Will it happen? What should you do? Consider all the parts of the coin, and then only you would be able to prepare yourself for what lies ahead. Because rumors ke liye, fear mongering ke liye, there are enough and plenty channels, headlines, items. that will ultimately sway your decision to sell everything and run away, or to buy everything when there is not a need to. All right. Now, let's come to the important part, which is what should you keep in mind as an informed investor? Remember, you are now an informed investor. The reason that you're watching this episode, this masterclass, is that you have to become an informed investor and you have to become a successful investor. That is our endeavor, right? So let's look at what you should be seeing, which others are not seeing. Number one, since March of 2020, we've seen plenty of liquidity being pumped into the market, and by all central banks across the globe of every possible country that you can name. With these liquidity measures, of course, it is allowed for the economic growth to spur, the revival to happen, but at the end, you're also looking at the dreaded woes of inflation. And it is very important for the central banks to keep the inflation targets in check as well. And hence, if capital, bold, underline, font 100, if the tapering does happen, if there is a lowering of the interest rates, and if there is a need for us to control inflation, then this is a good thing to have. Number two, unlike the taper tantrum of 2013, this year I've already explained this to you that it's very different. This will not lead to an economic slowdown. People have gotten used to it. They want good things always to be there for support. And in the end, who cares about inflation if they have a lot of discretionary spending up their sleeves, right? But this time, everything needs to be balanced. And if at all the taper tantrum does happen, if at all tapering does happen and the tantrums don't, that is what we're feeling, the economic slowdown will not happen. Most importantly, you've seen on 23rd of March 2020, the index go down to levels of about 7,650. And today, as I speak to you, the index is 17,200 odd levels. Between March of 2020 and today, the September of 3rd, you've seen the index go from 7,600 odd levels to 17,200 levels, a jump of about 124%. If in a market you can see such a jump, shouldn't you be prepared for a correction as well? Ask yourself that question. But more importantly, ask yourself the following questions. Number one, it is a consensus that the nominal growth of GDP for the next 10 years will be 11% plus. For the next 10 years, the nominal growth of GDP will be 11% plus. Number two, the earnings are expected to double up from these levels. Number three, it is said that even if the indices were to mimic the earnings growth, then in 5 years, the earnings would double, and so would, in a period of 5 to 6 years, the indices. So what you're seeing today as the 17,000 odd levels, in a period of another 5 to 6 years may not be 17,000. It may be well a figure above 30,000 odd levels. So if you're worried about a correction of 5, 4, 6%, then you should not be investing in equities. You should not be. Because you're not looking at the bigger picture. The bigger picture is that the future holds a lot more than you and I see today. Because everything from here on is on a growth path. And last but not the least, even if there is a correction that happens of 4, 5, 6%, should you be selling your holdings or should you be buying more of the quality stocks that present an opportunity if that moment arrives? Think like an informed investor, for heaven's sake. Will the tantrums lead to the market correction? God knows. There are many other reasons that could lead to a market correction. Will your portfolios get affected? Maybe for a while. But should you sell it? I don't think so. Is the economic condition intact for the next 10 years? Well, I surely believe so. Do we see the earnings growing from here? Well, hell yes, we do. Should you as an investor be looking at 5 years, 10 years as investing horizon? You should. And this is what I said, as an informed investor, you need to be thinking differently than a person who's reading headlines. I hope you enjoyed this masterclass that comes from our board to you. This is a collector's edition, not available anywhere else. The whole aim is to make you a better informed investor. Wishing you You and your loved ones the best of the health ahead. This is Sanjeev Anand signing off till we meet again.